Welcome everyone to today's video in which we're going to talk about SoFi stock because this stock is down 37% in the past 3 months. It's a very popular YouTube stock. The stock is kind of a small cap company as the market cap is $22 billion and they are generating $3.5 billion in revenue, up 35% compared to last year. So a high growth company. Now their profit is down compared to last year, negative 3.5%. However, analysts have them rated as a buy with 47% upside. Now this is a very volatile company. If we pull up the 5-year chart, this company used to trade around $20 per share, then fell all the way to $4 per share, all the way then up again to almost $30 per share, and now to $17 per share. Now, full disclosure, I used to have a SoFi position. I bought the stock when it was trading around $7 per share about a year ago, and then I sold the company a couple months ago. So this investment did tremendous for me as I sold it when it was around $26 per share. And I made over 300% gains in a couple of years, which is amazing. And therefore, in this video, I'm going to share my thoughts on whether I think the company is a buy at current prices. We're going to look at the financials, the forecast, the balance sheet, and some important statistics, as well as running a discounted cash flow model to calculate the intrinsic value of the company and potential future returns. And the first thing that attracted me to SoFi stock was the amount of growth this company has. Their revenue in the past 9 years has grown from $506 million to $3.5 billion, which is insane. And they are currently growing at around 30% per year. And what I love about this company also is that it acts as a one-stop shop for digital financial services, and it has become extremely popular. In fact, they are currently at 13.7 million members, growing at a compounded annual growth rate of 41%, which is insane. Their products, again, are growing at a compounded annual growth rate of 41%. So this company is growing everywhere. And this growth is expected to continue. In their guidance, they guided for the full year 2026, $4.6 billion, which is 30% year-over-year growth. Also, adjusted EBITDA, 52% growth, net income up 72%, and diluted EPS up 54%. Also for Q1, so next quarter, they are guiding for 35% year-over-year growth. And their profit has also seen amazing growth. If we take a look at net income, this used to be an unprofitable company, and in the past couple of years, they are now generating around $480 million. They have also improved their margins substantially. Their profit margin is currently at around 13 to 18%. And as I said before, it used to be negative. And if we take a look at the financial forecast, analysts are also expecting very good growth in terms of revenue and EPS. Revenue is expected to grow from $4.7 billion in 2026 to $6.8 billion in 2028. And as far as EPS, 61 cents per share, and then growing to $1.04 per share. So very good growth in terms of revenue and profits. And SoFi also has a great balance sheet as they have $5 billion in cash and $1.9 billion in debt. And therefore you might be wondering, well then why did you sell the company if everything looks great and still a lot of growth is expected? Well, there are two main reasons. Number one is because of the number of shares outstanding, and the share dilution is crazy. They have been diluting shareholders by a lot in the past couple of years. Last year, for example, by 13.6%. This is horrible for investors because you own less of the company and you have to share the profits with more people. And the second reason is because I believe the valuation got a bit stretched. In order to calculate the intrinsic value of the company and potential future returns, I use my Google Sheet or discounted cash flow model. This tells me at what price you should buy a stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. And the intrinsic value, as you can see, according to my low assumptions, is $7.2 per share, middle 15.3, and high 28.9. And you can clearly see why when the stock was trading around $7 per share, I thought the company was heavily discounted, and now that it was trading recently around $28 per share, I thought it was expensive. Now the stock is trading at $17.8 per share, which means that if my low assumptions occur, you would get a negative 4.8% annual return on your money, middle positive 7.3%, and high positive 18.6%. So I do believe SoFi is getting back to that intrinsic value around fair value, but still, I believe it's still a bit expensive. But now I want to show you what happens when a company dilutes shareholders and how that affects the return on your money. So now I assume SoFi issues 5% of their shares annually for the next 7 years, keeping in mind they are doing over 10%, and now the returns are negative 8.8% according to the low assumptions, middle positive 2.9%, and high 13.6%. So you can see how this decreases your returns. Now, as far as the rest of my assumptions, I assume it grows revenue between 10 and 20% annually for the next 7 years. They average a profit margin and free cash flow margin between 10 and 20%, and I assign the PM price to free cash flow at the end of the 7 years of 18, 20, and 22. But if you want to make your own assumptions, I'm going to leave a link to a spreadsheet down below. Super simple to use because I've done all the calculations in the background, so you only need to input your assumptions. And you can use this tool for any stock you want. And in conclusion, although SoFi, I believe, is a fantastic company that is still going to have tons of growth, and I believe now the valuation has gotten much more attractive than around $29 per share, I will be interested probably at around $12 or $13 per share. Now, also I am concerned about the share dilution, and I know it is typical for new companies to issue shares, but SoFi has already been around for 5 or 6 years, and they are in a great financial position. So I would prefer if they stopped issuing shares, as this hurts shareholders massively. And also it is true that I do have a bias, as I bought the stock and then sold it and made some really good gains, so it is harder for me to jump back in straight away. Also, by the way, if you want access to where I've shown all the data in this video, you have my link to stockanalysis.com in the description. I hope you found this video valuable. Let me know what you think about SoFi stock in the comments, and I'll see you in the next one.